Good afternoon, good morning, wherever you guys are at today in the world. This is Philip Morris with our second episode of Stockommon Cents. I'll be taking you through the events that happened this week during the stock market. This is currently recovering the week of, covering the week of February 28th. So yeah, let's go ahead and get started. Well, let me go ahead and tell you guys this. Thank you for the support that you guys have given me throughout the week. I've received great reviews, feedback, and I just want to let you guys know that as we continue to grow the channels, that all those things will be implemented. And I just want to make sure that this is a great show to where not only are you learning, not only do you have an input on how the show runs and operates, but it's something that you can be able to use for your investing and training purposes. So without further ado, we're gonna go ahead and start off with the S&P 500. Everything was good in my prediction until Friday. If you remember last week, I had a good assumption that we would be rising in the market. Now, going into Thursday, we were up. By the end of Thursday, we were flat. Then by Friday, with the news of the shelling in Ukraine of one of the biggest nuclear plants in Europe, we went down. We ended up down for the week 0.79%. After the news, we were down as much as 1.5%. So if you can see this wick right over here, this bottom one, we ended up getting to as low as 42.79 and was able to. And we ended up buying back up. I am under the heavy belief that we are currently, I feel like each dip moving forward will be bought. And I feel like we will be at a sustainable level. Now, we weren't able to break the level that I wanted to get to, which was 43.50. What is this? Yeah, around 43.50, 43.40. So we hit that and we were rejected. So we will see where we go. I do think our safe spot is around 41.20, but I personally don't think we will get there. But 43.50 was a range that was rejected and weren't able to close. So what I mean by rejected, I wanted to see this candle close or finish above this line right here. And as you can see, with this being a red candle, we look at the top of the candle and below the candle. That lets us know where we ended. So this is the top, this is where we started, this is where we ended. If it was a green candle, that bottom is where we started and the green is where we ended. Okay, so I'm gonna go ahead and give you guys a quick candle review. So as you can look, we did have two wicks above, and we did get to as close as 44. How high did we get to? We got to as high as 44.16. And then the bad news started trickling in. So for the week, once again, the S&P 500 was down 0.79%. We will see where things take us next week. But again, I do want to close above this level to be able to see bullish sentiments. If not, we might be ranging for the next few weeks. Moving on to the Russell 2000. 1 second. If you look, we were also down for the week. For the Russell 2000, we were down almost 2%. We're down 1.96%. We do have a bit of a ways to go for us to get to levels that we do want to get to. As you can see, the level we want to get to in the Russell 2000 is around 2220, 2210. I feel like that would be respectable levels, but until then, it looks like we will be ranging. We did hit the rejection line around 1964, and we were able to bounce off of it. Now, I want us to be able to get past this level right over here. This is a level that I see as very important. Maybe even over here would be an even reasonable level. Let me set this line. Even this could be a reasonable level that we could hit. Because if you can see, we do get close and rejecting and going back lower. So we are range bound between 15.64 and 21.10. So we'll see where that takes us for next week. Once again, we were down for the week by 1.96%. Again, we'll see where the week takes us next week. Now, on to things that happened during the week. And as I alluded to before, the good old Russia-Ukraine issues. Now, once again, I don't discuss politics. I'm not here for the politics and the global issues that occur around the world. I'm not an expert in that, so I'm going to make sure I stay clear across as much as possible, but it does affect the market. So I do want to make sure that I do give you guys updates so you understand where we are at and what could come from this. Now, as I stated before, oil prices have been going up. If we want to go ahead and look at crude oil currently, because of the issues in Russia, you can see, yes, huge pop this week. We opened up at 94, basically $95 a barrel, and we got to as high as $16. Ended up closing at 115. So a barrel is costing $115 per barrel. Now, because of this, you will see this impacted throughout the states. I did see some states that or in California, I believe I saw certain sections of California around $7. I saw a picture of, I've seen some at $6. Here in Texas, we are currently filled up today, and that was around $3.69. So I guess I can't complain since other places do have it worse, but yeah, this is affecting a whole bunch of us. Now back to Ukraine. There have been some talks of ceasefire, or at least a ceasefire through involving civilians in a way. I think they're trying to create like a corridor or a passage for citizens on both sides to be able to escape. We're currently on our third rounds between Russia and Ukraine to go ahead and discuss that. But there have been more artillery fire. There, like I alluded before, there was a shelling or attack on one of the biggest nuclear plants in Ukraine. I want to go ahead and send my condolences to all those dealing with or who are impacted by this. Nobody wants a war. Nobody wins when people are fighting over issues. Yeah, I'm just wishing for well wishes all across the board. So yes, we do have negotiations currently taking place. We do have major economic fallouts. Let me go ahead and show you guys one. I have talked about oil, but let's talk about some other commodities like wheat. So if I can find wheat. One second, I believe. Here's a commodity of wheat ETF. This one would be WEAT. If we look at this commodity, this big candle is what occurred this week. Beginning of the year, we opened up at $7.42. Today, we closed at $10.83, getting to as high as $12.75. That's just wheat. Let me see if I can find soybeans. No, that's not it. I don't know all of my commodities, y'all, so please forgive me. But commodities are, especially wheat and soybeans. Soybeans are one of the ones, are some of the, here we go, are some of the items that have been rising due to these issues. So if we look for soybeans, we got to as high as 17.59. We opened the year at 13.49. Now let me go ahead and show you a stock. This is US Steel, symbol X. You can see here, even this is going up. This is once again US Steel, which is X. We opened up the year at 24.13, currently as high got to as high as 31.55. So this is making everything way, way, way more expensive. Um, as we try to grapple with inflation, as we try to grapple with the war, all these things are occurring. And a stock that you can even look up, energy, materials, and industrials. Let me go ahead and show you guys this one. This one is XLE, which has been running amok, uh, which has been running amok on the stock market. Opened up the year at 55.58, got to as high as 75.23. So I believe that's what 35%, around 30% that it's increased. Let's go ahead and look at XLI, which is what's XLI? XLI is for, second. I'll make sure I'm giving you guys the latest and greatest. I know my symbols, but I don't always know the correct terms for them. XLI is the industrial sector. I'm sorry. So some of the top companies in this one will be Union Pacific, Raytheon, who is this? UPS, which is a big one. You have Boeing, Lockheed Martin, which is a big defensive company. We'll talk about that in a second. But XLI, that opened up the year at 106, currently at what, 100, so a slight decline. But let me show you. Let's see, 1 second. I might have been the wrong one. Let me give you. Well, let me go ahead and show you guys this. Let me show you Boeing, or not Boeing. Let me show you Lockheed Martin. Whenever we go to war, you'll always see defensive companies shoot up like this. They always get a good pop. So if we look at Lockheed Martin, we opened up the year at 354, and we're currently got to as high as 462. That's a stock you may want to watch out for as we continue our issues overseas. Let's go ahead and look at Raytheon, which is another defense company. This symbol is RTX. Started the year at 86.08, got to as high as 104. So all within 2 months, you would have got a good size pop in your portfolio had you bought this stock. And so while it feels wrong to profit on wars and issues, there are clearly people are doing it. So yeah, I personally, I don't like to. I'm gonna leave that alone. I'll go ahead and leave that alone. Do what's best for your wallet at the end of the day. Getting off of this subject, I'm gonna talk about the post-coronavirus economy. If you notice, more and more and more states are becoming more laxed to the coronavirus. So, for example, New York and New York City, one of the pandemic epicenters that started this, or not started this, but where everything kicked off. They are ending the restrictions on, what day is it? I believe it's March 7th, that they will be rolling back some of their issues or some of the restrictions. So for example, they were one of the cities to where you couldn't enter restaurants, gyms, even some arenas without having a vaccine card. So for New York City, they'll no longer be requesting vaccine cards. No, masks will no longer be mandated for public school students 5 and older. This is really big. And I'm not going to get any political views whether you should wear a mask or not. I'm only here to talk about the markets. This is basically driven by the economy. Simply for the fact that we're trying to get a grapple on inflation. Supply costs are through the roof. We want to make sure that our people are healthy, yes, but this is a big effort to try to drive down the costs. Again, as we grapple with inflation, as costs continue to go up and the infection rates start to go down, this was bound to happen. New York currently has a positive rate of 1.7 or 1.6 over a 7-day average. And I feel like you'll start seeing this more and more and more domestically and even internationally as we come to better grips with the coronavirus. I know California has also rolled back some of their restrictions as well. You'll start to see this going across nationally. So some stocks you could look out for that could rebound. If we look at Booking, yes, 1 second. Yes, Booking Holdings, which is BKNG. You can expect a pop to come from here. Now, there was a big drop. We did have earnings. Let's see what the earnings said. 1 second. Yeah, so it looks like they beat earnings. So we'll have to figure out what occurred there for there to be such a big decline. But Booking Holdings is one that you may want to look at if you want to look at Airbnb. As travel restrictions start getting more relaxed, they opened the year at 165. They're currently at 142. This may be one that you want to look at or at least have on your radar. Even Jets, which is a U.S. Airlines ETF. Once again, it's not just a stock, it's an ETF that has the top U.S. Airlines. This may be one that you keep on your radar as well. They opened the year at 2135. We're currently at 1903. Once again, as COVID infections and as we start to get a better handle on COVID, you should start to see some of these stocks either take off, rebound, or start to, produce gains as the economy opens back up fully. Next topic. Primaries. Again, I don't cover politics. I don't, but I do cover what occurs in the market. And if you don't think primaries or midterm elections have something to play in the market, you would be fooled. Now, Texas started off our primaries, our primaries to see who will run for governor. Now, again, I'm not into politics. I'm not going to. Here's what that means. I'm going to show you guys this chart so you can see. Typically, midterm elections cause rockiness within the market. Here is why. The market likes to have certainty whenever we are trading or whenever we're investing. If we don't know what's going on, if we don't know who will be in office, who will be enacting what rules, it tends to put the market either in a rocky place or mute until then. Now, if you're looking at this chart, you can see where midterm elections happen, which is this bar over here in the gray. If you look at each month, you can see the average or what occurred each year. So we have 2010, 2006, 2000, and 1994. And you can see how we hover near the 0%, sometimes flat, sometimes negative, big dips. And as we get to the election year, we're flat and we tend to rise off after. Now, it doesn't mean that's what's going to happen every single year, but it gives you analysis to understand what is going on within the market. Now, here is the S&P 500 index, price return after a US midterm election. You can see starting from 1951 all the way into 2015, the returns after 1 year after the midterm elections, right? After midterm elections, we averaged 15.1%. All other years, 6.8. 6.8. It's got to tell you guys something. You can see the volatility in the S&P 500 as well since 1970, and that's the VIX. We talked about the VIX last week. The VIX lets you know the uncertainty within the market. And if you look, we hit peak levels leading up to the midterm elections. So from June all the way up into November's. Now, I'm not giving that advice, but if you sell options, you can sell options to collect premiums within your portfolio since they are elevated and they are higher. Again, I'm not here to bring advice. I'm just here to give you guys some data. Now, here are the S&P 500 year-to-date returns during midterm elections. You can see they're typically lower than all other years, but then you can see the rise right after the election, right? It's very steep, very long. And you can see the average, how we end up being flat throughout the year and the pop off. Let me see if I have another chart for you guys. Here's another one as well. I believe this one tends to show the exact thing that I was showing you guys before, how we, in midterm election years, we end up flat leading up to the election and then typically rising up some in November, averaging near around 4%. Then we rally off, get to as high as 6% in December. And again, market returns after midterm elections have been strong. 15% after midterm elections, and all other years, midterm elections, 7.1. So I'm going to talk about some key performance indicators, things that happen during the week. Once a month, we do talk about our non-farms employment change. This is a big number because this feeds into our employment numbers to see whether we are increasing, whether we are getting, whether the economy is rebounding or adding more jobs. Our forecast was 407,000, and we ended up pulling off 678K. So this is really, really, really good news, showing that the market is, or showing that the economy is rebounding. Remember, this was a key number for Jerome Powell to see whether we'd be able to increase rates so we can be able to handle inflation. Last month, we were at 467, and in January, we were at 199. You can see both, the green shows it is good, red shows it was bad, so we did have a really good green month. Well, to mention Jerome Powell, he was talking about raising rates in March. It's looking more and more likely that rates will increase by 0.25%, which was definitely along the lines of what we expected. But from there, we have no clue to what other rates will be raised. So I want to go ahead and make mention of that. I keep telling you that the Fed will be raising rates. It's a number that we are looking, it is a measure that the Federal Reserve is looking to get resolved as you try to handle inflation. Unemployment rate, forecasting number was 3.9. Anything lower than 3.9 is good news. Our actuals is 3.8. So that is great news. Our unemployment rate is lowering. Last month we were at 4.0. And our average earnings month over month. Now, this is also a big number, hence the red folder. And by the way, this is Forex Factory. This is what I use. I'll place a note at the bottom of the screen so you can see where I get my data. Where average earnings month over month show is basically how much are employee wages rising month over month. We did have a forecast of 0.5%. We did not reach any of it. Nothing. Zero. Big zero. This shows the change in price business pay for labor, not including the pharma industry. This is a big number that we do want to be able to increase, so we want to be able to pay our employees, right? Pay the working class. So a number that's forecasted or higher is good. Anything lower than the forecast is bad. So 2 out of 3, we did hit great numbers. This could have rebounded the market, could have been good news. Well, it is good news, but like I stated before, it's we got some things happening overseas. So, okay. And one thing that's important to me, the 5th one is always something that I find important. I think, yes, it can be market related, but this is what I think is pretty big. TikTok and social media. Now, of course, I'm 32 years old. I grew up in the internet social media days, so I do understand it. But unless you've been living under a rock, social media is affecting adults, it's affecting preteens, teens, everyone who has access to it. Now, a group of attorneys have announced an investigation on TikTok's impact on young Americans. Now, we've also seen these sort of things happen to Facebook, other social media platforms. But what this is basically saying is that they will be probing TikTok's user engagement techniques and alleged risks that the platform may pose to mental health of children, of course, announcements by states. Now, I forget what the show documentary was called on Netflix, but let me see if I can pull it up real quick. It's called Social Dilemma. I encourage you guys to watch it. You can see how this is basically a drug to users, to where it is tough for you to be like, what I want you guys to do, try to go a day without being on your phone. Try to go 2 days, right? Reason being is they are finding ways to shoot in attention to where attention is now a drug, right? They get paid the longer they keep you on their websites, on your phones, on their apps. They're finding different ways to get you to stay on their apps so they can collect more revenues through marketing, through sales, anything that they can get. I can't pose to you how important it is to make sure that you're watching yourself on these apps. And I encourage you guys to watch Social Dilemma, simply for the fact of a lot of these executives don't let their kids use the apps. That should be a telling sign to you. That should be a very telling sign to you. Now, stock of the week. I told you guys every week we'll be talking about a stock that is not, I'm not gonna say popular, because I will hit some of the heavy hitters, but I don't want to hit all the ones that we already know. I don't think we need a market breakdown on Apple or Microsoft, on all these big tech companies, but I want to talk about companies that may be flying under the radar. So I'm going to show you Coca Cola, stock symbol KO. I'm going to show you guys a 5-year chart. You can see 5 years ago, the stock opened at 42.34. Today, we got to as high as 63.02. Now, this is what I call a steady Eddy chart. If you were to set a trend line, let's do this. You can see, I mean, you could have seen it before. This is a very steady Eddy chart. Now, why I picked Coca Cola is we have to think about it on this end. In America, and not even just America, this is a global company. The reason why this is so good to me is that think how many brands they have just within Coca Cola, right? You have Sprite, you have Coke, you have vitamin water, you have, let's see if I can pull up a company breakdown. Here we go. This is a company that typically does well year after year after year. And once again, this is Thinkorswim. You could pull up a whole company breakdown within their or a whole company breakdown. And yes, we all know Coca-Cola is a soft drink company, but what they are able to bring into the market, I mean, they have juices, they have ready to drink teas, they also have coffees, wine mixers. Of course, they have their soft drinks, but they are a power player within the market, very power player. But what I like about them is that they are very steady, Eddie, Eddie, steady, Eddie, Eddie. You're not gonna find a whole lot of, you'll find growth, but it's at a very declined rate. Let's see if I can do this. So hit it to the top here. Within 5 years, this company has grown, let's see. A couple of percent. Let me see how much this is. Sorry, I could have wrote this down for you guys. Within 5 years, this company has grown 47%. So if you were to put in $5,000, just rounding it up, you would have made at least half your money back, so at least 2,500 within 5 years. 10 years ago, looking at this company as well, they opened up at 36.92. So almost doubled your money. Now, here's why I like this company as well. If this stock typically beats earnings, again, typically beats earnings. So if you, let me go ahead and show you guys this as well. Ameritrade. You can see the earnings symbols at the bottom of the chart, all right here. So if you were to click the telephone, you can see earnings last quarter was estimated of 40 cents. They beat it. They ended up getting actually 45% or 45 cents. That's good. Last quarter, 58%. The actuals were 65%. Quarter before that, estimated was 57%, actual 67. Another quarter, basically 50 cents estimate and 55%. So what they're saying is each quarter they have beaten earnings, which is basically the analysts coming out and saying, hey, we think they earned this much, and them going on an earnings call and saying, nah, this is what we're actually earning. Sorry. So that's pretty big. Their chairman and CEO is James R. Quincy. He became CEO in 2017 and ended up joining Coca Cola in 1996. Since 1985, Coca Cola has had 8 negative years in 36 years, 2 since 2012. Let me show you this. This is what I mean by a company that is getting the job done year after year after year. So if you were to look at this chart, they've been around, publicly traded since 1985. Every candle in red is a bad year. Every candle in red. 1, 2, 3, 4, 5, 6, 7, 8. Mind you, the last bad year was in 2020 when Corona occurred, and we still had a nice recovery. Opened the year at 55.32, got to as low as 36.27, and ended the year at 54.84. Okay. Now here's another one I wanted to show you. I wanted to show you guys the quarters. Now, this is why I like this stock a lot. If the company has a negative quarter, the dips are very much viable events. So here's what that means, right? We know that there are 4 quarters in a year. Here's a quarter where we open the year at 54 cents and close at 52 cents, right? So down a little less than 5%. Look at this big green bar from 52 up to 59%, or to 59 cents. Okay. Another bad quarter. Opened at 54.27, got to as low as 48, but we closed at 52. Recovery, same next quarter. Big bad quarter. Of course, this is Corona. Now it took us 1, 2, 3 quarters to basically get back if you had bought at the open. I mean, at least close to, and then recovered by the 2 quarters after, right? Here's another one where we're flat on the quarter. I mean, we're negative, but we're flat on the quarter. Look at this recovery. Again, now these are things that you want to keep eye on whenever you're investing in companies, right? You want to be able to know your company backwards and forwards, backwards and forwards. Now, if we're looking at analyst predictions, let me pull this up. Analyst research, which your brokerage should be able to have. Your brokerage should be able to have analyst research on the stocks that you own, or stocks that you may be interested in researching. I'm gonna pull this up so you guys can go ahead and see it. TD Ameritrade, which is where we have our brokerage. They are one of my favorites. So pulling up analyst research, we have our bear case, which is $60. We have our average whole case or base case, which is $67, and our bull case, which is $76. What this is basically saying is within the next 12 months, a couple of analysts, which we have a couple showing that our base case is be at $60 at the end of the year. Coca Cola, again, is currently at $62. Then we have base case 67, or base case, 67.40. And then our bull case, we have some analysts thinking that we will get to 76. We have a lot of the analysts showing that this is a buy company. So buy this stock. You typically have buy, hold, and sell. Hold is, hey, we think the company's doing exactly what we think they should do. We have sell ratings, which analysts are saying, hey, sell the stock, or we think the stock is overperforming. We believe it should be lowered. And you have your buy holdings, which says, hey, the stock is doing great. We think it'll get to a higher case. So just something to be wary of. Okay, this is Coca Cola. Now, a quick tip of the day. I want to go ahead and show you guys, and we'll do more of these. I'm just going to run through this really quick. But income statements. Income statements, a company that is public is bound to, or they are forced to show you what the company is doing within the year, right? Or for that current year. What income statements show is from the first quarter to the fourth quarter, how a company operated, how much money they made, how much they spent, how are they doing in sales and revenue, and where they're spending. Just because you buy a stock and you think, or just because the stock price is high, doesn't mean a company is always doing all that well. You want to be able to dig into the numbers, right? So this is Coca Cola. Stock price is at $67.52. But if you look, this is how the revenue has been looking year after year, 2007, 8, 19, 20, 21, right? And you can see that reflected here. 2021, when they ended the year, this is the biggest year that they had in the last 5 years, bringing in $38.7 million, right? That's cool. What were their expenses? 27.8. We also have 26.8, 28.1, 23, which 2020 is an outlier because it is a COVID year. And then last year, 28.3. So they are getting a manage on their expenses, with the biggest chunk of expenses being their SG&A costs, so selling, general expenses, and admin expenses. Okay. Looks like they don't really have, well, they do have a advertising budget, but I guess they have everything rolled up here for this year. We'll have to do more research into that. But the big numbers that you want to look at are your total revenue, and that came out to 38.7, and then our operating income, or operating expenses, what they spent. This is what they keep before taxes, total operating income. So for the year, they made $10.3 billion after expenses were made. And every single year, this number has risen Even in a year of Corona, this number has grown year over year. This is very big news. And once again, you can see these numbers. You can see these numbers with any brokers that you have. Any public company is forced to every public company is forced to show you income statement, balance sheet, and cash flow. Now, why is this important? Let's think about AMC, and we'll do this real quick. I know I'm running over on time. Let's look at AMC. The reason I was not a big investor in AMC is because this company doesn't make any money. Sorry. You can hate me all you want. This is a big time movie company if you don't know what AMC is. But during the whole GameStop craze, when the stock was shooting up and people were jumping in, I stayed out of it. Well, why'd you do that? Well, let's look. We had our total revenue, which is displayed in the millions. This is how much they made: 3.2 billion, 5.1 billion, 5.5 billion. Okay, that's cool. 5.5 billion. Last year, in 2020, $1.2 billion. Okay, cool. That's fine, right? But let's look at their expenses. Expenses 3.0, basically 5.0, 5.2, 5.3, 5.2. They're barely clearing. They're basically flat every year, except for 2020, where they lost $4 billion. Okay, so that's just an annual. Let's look at their last quarters, right? You can tell me, okay, well, they're rebounding. Okay, well, prove it to me. Revenue, expenses. Now, again, we're on a quarterly basis now. Look, all negatives across the board. Would you invest in a company that's losing money every single year? I wouldn't, me personally. Now, 2021, yes, we had COVID restrictions and we're slowly getting off of those. But look, you're still losing money. Still losing money. I don't want a company that's barely getting by. This is a billion-dollar company. This company is worth market cap $8.6 billion. $8.6 billion. Mind you, if you look at their chart, let's look at their chart, AMC. This was a company that was steadily losing money. This is a 10-year chart, steadily losing money. This isn't a chart I want to invest in. They got to as low as 191. Now they're currently $16, but do I think movies are going to make a big return? No, this is already a dying industry. So why would I go in and buy more? These are things that you can look to as you're investing, as you're becoming a better, more knowledgeable investor. So this is your episode for Stockommon Cents. Once again, I'm trying to keep this to as low as 30 minutes, but I as you can tell, I love to talk about stocks and business and things that I love. I'm gonna do my best to get this down once again, but I just want to be able to give you information that I believe you guys can use. So you guys have a great day.